Are you an early stage founder revolutionizing the future of retail? Then you're in the right place. My name is Shah, and I'm an angel investor investing at the pre-seed and seed stage in retail tech, e-commerce, marketplaces, and consumer. I'm also the founder of Retail X Series, an ecosystem to help early stage founders in the retail and consumer sectors. Retail X Series includes events, a YouTube channel, a Slack community, resources for founders, and this podcast. In this podcast, I interview founders, investors, and experts in the retail space, and we dig deep into the tactics around key topics that early stage founders want to hear about. Welcome to the Retail X podcast. Hello, everyone. Welcome to the Retail X Series podcast. I'm your host, Sevin Shah. Today's episode is going to be a little bit different. We're going to be talking about whether a startup should even be raising VC. Our guest today has been on the podcast before, so many of you may know her already. Leigh, Sevin, co-founder of Endear, has an interesting take on raising venture capital for a retail tech startup, and I'm excited to dig in further. Welcome back to the podcast, Leigh.
Thanks for having me. Thrilled to be back.
Great. So let's start, before we dig into the meat of this topic, let's give some context to our conversation and what your thoughts are going to be. Let's start with you telling us a little background on your company, how long you've been in business, what your current stage is, and then we can talk about your fundraising journey before we really dive into the more controversial sections of this podcast.
Awesome. Yes. So Endear is a CRM for physical retail. So the way that we think about it is providing the same software to B2C salespeople as a HubSpot would provide to B2B salespeople, like the salespeople at Endear. So we really got started. We launched as a Shopify app in 2019. At that point, just for the sake of this podcast, we had raised, I think, all of $250K in friends and family. Then we launched formally out of a beta that we did from 2018 to 2019, and then really had some real growth actually because of the pandemic. So we became a resource for brands when their stores were closed, the idea that their salespeople could actually sell from home and focus their attention on e-com rather than just what would happen within the four walls of a store, transitioning that relationship over to email and text with their customers. So today, we are a seed stage company. We've raised all in about $4.5 million. We're a team of about 16 people.
Great, perfect. Let's talk about the fundraising part. You've raised about $4.5 million. I know it has not been an easy journey to get there. So can you talk a little bit about what has been difficult, where you've seen success, where maybe things weren't as successful for you in that process?
Yeah, sure. I think we actually have had some hilariously timed fundraising, and that's really not what I'm here to talk about, but just to give everyone some context. We raised friends and family like back in 2017, and then we actually closed our pre-seed for a retail tech startup March 11, 2020. So New York would actually close its doors March 14. So that was just a wild time. And then that round we raised 1.1. And then we raised another 2 million again in basically at the start of 2022. And then we actually just closed another million. And our first wire was supposed to come in the day that SVB went bankrupt, or basically went under. So we've seen all the hits, but honestly, none of those things were the challenge. The challenge was, what was the right capital market for Endear? And as I said, our first real raise was a friends and family round. I think it was about maybe 7 or 8 individuals. And then when we raised our 1.1, we were in a really interesting position because my co-founder and I, you can talk about like lean startup, you can talk about sustainable businesses. Like lean startup, I think we were even past that. Like what we were trying to do was basically get to profitability as soon as possible because we just thought that would make for a great business. And it does. It's just not the kind of business that necessarily VCs, especially in 2019, 2020, were looking for. In fact, like people were spooked by the fact that we were talking about profitability. And so one of the best pieces of advice that I got is I went to a non-VC family friend mentor of mine and explained the position we were in. And he was like, I don't know what VCs are up to, but this sounds like a great business to me. I'm an individual. I work in finance. If you're telling me you're this close to break even, that's a business I'd be willing to back because it seems like you really know how to handle your cash flow. You're really thinking about revenue. You're thinking about unit economics. And that, as someone who maybe doesn't invest in companies professionally, that makes me feel really secure in giving you an angel investment.
That's so interesting. So I think one of the things that many founders don't realize is that angels actually have different criteria than VCs much of the time. And it sounds like that's what you hit upon there, which is that VCs are looking for certain metrics and growth, and that varies by sector. But angels, I think, don't necessarily need those things in the same way.
I mean, you are an angel. So I'll put it back to you. How do you feel like, how different do you think your criteria is from some of the VCs at a, call it pre-seed VCs?
This is the way I talk to founders about this, that my take, and I don't know if all angels are the same, to be honest. I think there's a lot of different kinds of angels, but the way I think about it is I want to be on the same side as the founder. So I want the founder to make money. Like you can sell a business like yours, right? For $100 million and you will be rich. You will make, as long as you, as a founder, still own enough of your company,
correct,
you will have a life-changing transformational financial event, right? And I would love to be a part of that because then I will also make money. And I don't need to return the fund, which VCs always talk about, because I don't have a fund. And so I'm very happy to have companies, to the same kind of point that your investor said, I'm happy to have companies that aren't raising a lot of money or are raising money because they want to get to profitability and continue to iteratively build a big business and then sell it for 100 million, 200 million, even 50 million if you didn't raise a lot of money. Whereas I think VCs are really more looking at it like, what is that $1 billion plus outcome? Because they need those, but they don't need every company to be that, right? They just need a couple of hits. And so they're placing bets, I think. Whereas I think angels are like, is this a solid business? And I'd be happy. And even if dividends were coming out of the business, I'm pretty happy on that in that case as well. So I do think an interesting difference that I think many founders maybe don't realize. What was your experience when you were talking to VCs about Endear? Because we also know that retail tech has gone in and out of fashion a lot in the last 10 years.
Yeah, it's so funny the way that you talk about returning the fund and big hits and moonshots versus, quite frankly, the rest of the portfolio potentially leveling out or completely folding entirely. And I think my co-founder and I, we really did look at it more from an expected value perspective for us. And that's not how VCs are evaluating the company. And so what we had to say is, hey, I have a portfolio of one, and I put my blood, sweat, and tears into that portfolio of one. And there is quite frankly, for what makes me happy as an individual, a really big gap between what makes me happy and what could return your fund. And that misalignment, I think, is what you're touching on as well. And there are founders who don't speak the way that I speak. They're like, I'm in this for billion or bust. And those are the founders and the companies that oftentimes need VC backing and also should get VC backing. And they are aligned. I think in that case, both people know, hey, if this doesn't go the way we want it to, that's fine. But we are both on the same track. And I think that is the hardest part for founders to reconcile, and something that I struggled with when pitching VCs, because they would ask me questions that I just didn't feel like I should have had to answer. I was like, listen, I'm growing really well. We have real revenue. We have really sticky customers. We love what we do. We're not burned out. Our employees hang out and stick around. Those are really great things. And at the end of the day, they'd be like, okay, but how is this $1 billion business? And I was like, but why does that matter? It's not that it's not. It's that you asking me to handcuff myself to that idea is why. It's not that you're doing anything wrong, and it's not that I'm doing anything wrong. It's the fundamental reason why we are not aligned. And that is why I think we really had to accept that we needed to find other types of capital markets to fund the business. And I think once we accepted that and came to that realization, again, while continuing to A, be able to raise some money, and B, continue to see our revenue grow. We just had more confidence around being able to look for that alternative sort of capital backing, because we just had to accept that VC was not necessarily going to be the right fit, at least in the way that we were operating at the time.
And what's really interesting about that is that you've actually managed to raise over $4 million without going down that sort of VC path. And when you talk about your rounds, it's not a traditional VC path of a pre-seed of $1 million, a seed of 3 to 5 million, a series A of 10 to 15, right? That would be whatever. The numbers change depending on where you are.
That's a normal trajectory, as you're saying. The rounds keep getting bigger, the valuations keep getting bigger, and so on and so forth.
Yeah, exactly. Which is that path when you're the billion or bust, and for those companies that kind of are on that path, but you're just on you're your own path.
We're on our own path. And I think what's interesting that I've found in talking to other founders is accepting that that's a real path. I think a lot of the time, the conversation around startups and around fundraising makes people not even ask themselves the question that you asked, which is, what are you in here to do? Why are you building this company? What is a great outcome for you? And once that question was posed to me, and we actually started thinking about that as the fundamental difference, I think it's a question that not enough people are asking themselves before they go down a startup track. And it is the most important question, which is, what is the outcome you are looking for? And then also, quite frankly, is the market you're going after able to bear that outcome?
Yeah.
And if those two things are misaligned, you really need to know that really upfront, because I think that's where founders fall into the trap of, again, handcuffing themselves to a track or a path forward that their market can't bear. And that's when you actually have real problems for everybody involved.
You know, what's interesting about this is that I think there is more of an understanding of that thought in maybe consumer products right now, right? Like products, CPG, apparel, these are categories that tend not, I think the market and the world is realizing that these tend not to be great sort of VC type investments because they just don't get that big, right?
Yeah.
But you're in the tech space, which I think by definition, founders think, oh, I'm building a tech company. Of course, I'm going to raise VC. Of course, it's going to be $1 billion or bigger. And so it almost feels that's almost a cognitive dissonance. Like, but you're a tech company. Like, of course you could be $1 billion. Why wouldn't you go down this path?
And the question is, of course, maybe you could be, but why go down that path? And ask yourself, the way that I think about it is there's this sort of bell curve of the natural business progression in terms of being a bootstrap lifestyle business, getting bigger and bigger, potentially getting acquired. And then at a certain point, there are actually a limited number of companies that can even acquire you. And then you really are on the path to IPO. And that's totally fine. I think it's more about reflecting on what is the right path for you. And I have to say, like, one of the biggest revelations that happened for us was whether or not there were other ways to fundraise. And I think that's also part of the problem, is there's not enough conversation around, okay, well, if I don't want to raise VC, what are my choices? And I would say back in 2018, you just had to know a lot of rich people if that's not what you were going to do. And not everyone has those networks. You know, I live in New York, finance is everything here, followed by tech, followed by a number of other really great industries. There are people here with that kind of money. But if you live somewhere else, or if that's just not a network you belong to, I think what has happened for us as we've gotten bigger is this binary, well, you can either bootstrap or you can do VC. Those are not the only two paths anymore. And I think there's a ton of literature in the startup investment space speaking about this. I'm not the first, and I'm also not the most educated because I'm just observing it as a founder, but the literature is all there. And as we saw those things come to be, it gave us a lot more confidence that we weren't crazy, because honestly, I swear, like, the VC market completely gaslit me. And I was like, well, there are other people who like appreciate the way that we're running our business, and they're going to help us. And they have, and that's who our investors are. They have helped us think through what is the right trajectory for the company, what is the real opportunity here, and let's be on the same page about how do we get the company to that stage where everybody wins, and making sure that winning looks the same as for them as it does for us.
Yeah, exactly. I want to touch on what you have alluded to a couple times, which is there's other things out there. And by the way, those other things are not just angels is not the only option, right? There are family offices, there's equity crowdfunding, there's product crowdfunding if you're a product-based company. And there are lots of different kind of answers to this. There's also I feel like this is a dirty word in VC, but there's also debt, right? Working capital lines and bank loans. There's a lot of ways to think about funding your company. And you're right, there's all of that information is out there, but we really only talk about the two extremes of bootstrap versus VC. But I think we're seeing more and more. I see a lot of startups, obviously, as an investor, and I'm seeing a lot more companies take that thoughtful approach and founders taking that thoughtful approach and saying, I am not sure if I want to raise. I don't know if I just want to bootstrap this or work with my local bank. To your point, I don't have a rich network of angels that I know. So what are the things I should do here? And I think that's progress, right? That you have to create that alignment and to honestly build a great company and be happy. You have to decide which path you want to be on. So I appreciate that perspective. Have you looked at kind of those other options besides kind of angels as well?
Yeah, I would say we've looked at everything at some point. I think the collapse of SVB has really brought venture debt into question. And so I'm going to leave that because at the end of the day, like what people have to know about venture debt is the asset that is collateralized is actually future investing from VCs. So it is a tricky little mechanism. And we did admittedly look at that kind of debt and a bunch of other revenue-based debt platforms like Pipe. And they're everywhere now. Clearco, Pipe. I'm trying to think of Waveflyer. Is that what it? Yeah, it's like they're all CapChase. Like even Stripe has a debt program. Shopify has a debt program. They're actually, I think, technically the same. And so debt is a great thing, especially if you have very predictable revenue. You just want to make sure that it's the right fit for your business. And what the advice we got on debt specifically was like, it works so long as you know how to take the 50,000 today and return 150 or 200,000 within the time frame you're expected to get that before you have to pay back that 50,000. So you do need to really understand your business. Definitely don't take debt as a way to figure things out. I would definitely not recommend that. But I think the real thing here that has sort of grown is the growth equity market at the really early stages. And that is the capital market we have tapped into. And there, again, it's hard because you need to really do your research on these different spaces and understand what are the pluses and minuses of all of these things compared to the way that you want to operate your business. Yeah. And I think that's the problem, is that it's always easy to go with the one that is most in your face and most prevalent. And VC is definitely the biggest market of them all. But that doesn't mean that there are not other ways to get funding for your company.
For sure. There's also things like strategic investors, right? Which potentially, to your point, are the people, are the companies you might exit to in the future. And I think one of the problems maybe founders do have is that there are so many options and you have to research all of them. And it's just like one more thing to do on an already full to-do list, but totally worth doing, right? To find that alignment. What do any of your early kind of investors to date, what do they think about as you continue to grow? Do they want you to continue to raise? Do they want you now at the stage that you're at? Do they want you to exit soon? Are they just generally happy to be where you are? How does that work when you don't have those kind of VC rounds where you're getting that markup and like an event valuation?
Yeah, you're getting a valuation. You're also getting validation from the market. It may or may not be real, which I think is what we're going through now. I think we had a slight, just good timing, which is that we've always talked about, as I said, we've always talked about profitability. And right as that has become, and all of a sudden it's trendy. I mean, it's not all of a sudden, it's because it's important when the economy is not doing as well. But I think we started talking about it at the same time that VCs were starting to really actually look for it for the first time. And so no one was surprised that this was a skill of ours. And I think the timing just aligned where hey, at the end of the day, they are our investors. And now it's less so, how are you going to keep growing? And it's more about returns, right? And so the thing about taking on investors early on, such as angels, is they have this opportunity where they can make actually a lot more money without you having to exit for all that much, because they just have an earlier stake in the company. And that's why you often read about the last player to potentially get in on your round before you exit actually might not make that much money. Or it's that balance of like, where did you come in and then where did you land? So I would say most of our investors, are just thrilled that we're continuing to grow and make incredible progress and really stick to what we know and have great traction. And I don't think at this stage we're saying anything different from what every other company has to be saying. So that sort of timing just fell into our lap. But I would say, if I had to guess, we are probably better at exercising that profitability muscle than most other companies.
Yeah, I bet. That makes sense. Do you anticipate raising more in the future?
We are in a really fantastic position where we just raised $1 million safe. We feel like that's enough cash for us to basically take the year, and I know it's already April, which is crazy, and look up at the end of a year and say to ourselves, what have we done and does it make sense? Does it make sense to raise again? What would have to be going on with the company in terms of growth and opportunity, and not just our own growth, but growth of the market that we're going after to justify another fundraise? And if not, that's why profitability is the best position to be in, because you're no longer dependent on outside capital.
I couldn't say it better myself. If I were starting a business today, and just to be clear, when I was an entrepreneur, I did not ever raise VC. I've always bootstrapped, but I am not sure, or depending on the kind of business, I'm not sure that this would be a path I would go down, but it's certainly something I'd look at. It is interesting to me that we haven't talked about the big elephant in the room here, is that women also get less than 2% of all the VC dollars, right? It also doesn't seem necessarily for many people that it's even a choice to raise VC.
It is the elephant in the room, because as someone who has literally said on this podcast, fundraising was not easy for me. I am so not interested in blaming my gender, because I actually, there's no way to prove for me specifically that's had any impact. And B, I'm the first one to admit that it wasn't that I was there trying to pitch someone on $1 billion company and they weren't listening.
Yeah.
I was trying to pitch them on all the other things that I thought should matter and they weren't listening. But I do think, to your broader point, I have just seen so many women go the bootstrap path because for all the reasons that women don't get funding, which is, at the end of the day, it is potentially like a latent bias. And if you can't solve it, which no one wants to be the woman to have to figure out how to solve it, while what you're really trying to do is run a company. You're not trying to solve one of the biggest economic disparities in the market. You're here to just build your business. And so I think it pushes a lot of people, and specifically a lot of female founders, to go down a bootstrapped path. And that's not necessarily, I think what's unfair about it is they shouldn't have to, but at the end of the day, if they get to run their business the way that they want and they can make it work, that's great. But I don't think it should have to, they shouldn't be forced to bootstrap because of their gender, obviously.
Yeah.
Obviously.
For sure. And it's interesting too, because I think at every stage, as we were just talking about before, at every stage in your company's journey, there are alternatives. If VC doesn't work, or if you really feel like the way I want to run this company is that I don't want to have any outside investors and I just want to bootstrap, because I just want to build a $5 million business and sell it, right? I want to build a $5 million Amazon business, sell it to an Amazon aggregator, and I'm pretty happy, right? And
Yeah.
And I own 100% of my company. That doesn't sound like a bad outcome to me.
I mean, what frustrates me the most, and I've actually had so many founders tell me this, I've even had friendly investors tell me this because they know where I sit now, is everyone talks about exit values, but if people knew how often a founder's money like actually the personal earnings of the founder would have been the same 3 or 4 years prior if they had been allowed to exit because of how much they'd been diluted.
Yeah.
That's the conversation that I don't think is being had enough, because everyone just makes assumptions around how much ownership a founder might have had at the end of the day, what offers that might have come their way that they were forced to reject because of the terms of their VC agreements. And so it's not to, again, I have no problem with the way the VC is set up. My point is that it is not for every startup company. And you need to be aware of the fact that good outcomes for investors are not always good outcomes for founders, and good outcomes for founders are not always good outcomes for VCs.
Yeah. And you just touched on a really important point, which I cannot tell you how many times I've said to founders, which is you really have to understand your cap table. It feels like something that you can outsource to your attorney, and certainly they can help you put it together. But you have to understand, if you raised a note and then you raised a safe and then you did another safe, how much of this company do you really own? Maybe before you get to a price round, or even after a price round and you do a bridge. I think a lot of founders don't spend enough time understanding that. And I've seen cases where you're 3 years into the company, you've raised $5 million, and you as the sole founder own 25% of your company. That's not going to be a good outcome for you, right? It's just, you really then have to build a $1 billion company to have a good personal outcome as a founder. And that might be a slight exaggeration, but doing the math and understanding how much you own as you're giving away pieces of your company, I feel like I'm doing a PSA. Like it's so important. I think it's the last thing on most founders' lists is to let me pour over my cap table and just make sure I know how much I own, that my co-founders own, that my employees own, that the investors own.
Yeah.
There are many surprises in cap tables at exits or even at various rounds in the process. And, just don't be one of those founders. That's my PSA for everyone.
Learn that. The funny thing is, if you think about all the things that we've talked about, and if you think about who starts companies, like, it's not easy to think about all of these dynamics when you are, and I was this age, like when you're 24 and want to start a company, you're like, I am 24, I'm going to start a $1 billion company. You don't even, quite frankly, unless you have a background in business or finance, you don't even know what $1 billion means or looks like from at least exiting for that, however you want to talk about revenue versus exit. But there are so many things that I wish I had known to think through, but if I had known to think through them, who knows if I would have done it. So there has to be that optimism, that like blind belief. And I don't regret anything. Like especially today, I am so excited for Endear's future. I absolutely love this company. I love our team. My co-founder and I have been working together for 7 years, and we are in this day in and day out, like side by side. So you need to have that optimism to even bother starting a company. But there are definitely things that you learn along the way that make you wish you had done the analysis that a lot of investors ask you to do day one, that you like just force together because you don't really know what you're doing and you don't really know anything about a product that you haven't launched yet. So you just take your best guess. And quite frankly, a lot of the time, you're probably taking your best guess by backing into the numbers that they want to see. And it's as you actually build the company that you understand whether or not those numbers were even accurate in the first place. And having to make those adjustments is really scary as you get bigger and bigger.
Yeah, for sure. I think there are a lot of parts about entrepreneurship that are very difficult, but really Excel spreadsheets and numbers, I think for most founders are just awful, because if you don't have that background, it's tough to learn and it's hard to figure out, for sure.
Yeah, and I think that's where like other founders who have done this before have to step up and help you, and like definitely ask for help, definitely be having these conversations about, your PSA, I appreciate. My PSA is understand what outcome you want and understand what it takes to get there from other founders who have done it. Don't just go in blind assuming that everything is going to be perfect. And definitely if you have a co-founder, make sure that conversation is happening at every fundraise and understanding how every fundraise impacts what it means you're signing up for.
Actually, I love that. That was a great PSA,
Yes, I
especially the
love that.
co-founder part, because
Definitely.
that it does happen where people have really different expectations and you don't know what you're signing up for. And having those very honest conversations right from the beginning makes a ton of sense to me, for sure.
Yeah.
This has been a great conversation, not the normal podcast that we usually do, but Leigh, really thank you. And thank you for being willing to take on this topic, which I know is very personal to you and your journey, but where I also have very strong feelings.
Yeah. No, and also it's amazing to hear that you were a bootstrapped founder. I think that gives a lot of people a lot of perspective on the way that you look at business, the way that all kinds of investors think about the way that the companies that they invest in. So love that you shared that as well.
Well, great. I appreciate your time. Thank you. And thank you to the audience for listening to this Retail Experts podcast. We'll have another new episode out shortly.
Thanks for listening. If you'd like to learn more about Retail X Series, check out www.retailxseries.com for more information, including recordings of past events. You can also follow us on Twitter and Instagram at Retail X Series. You could also learn more about me, find fundraising resources, or submit a pitch deck at www.redgiraffeadvisors.com. Thanks, and catch you next time.